Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going out there? It's August 28th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. Yeah, I've been so stressed out lately. I don't know if I told you guys this, but I had a flood in my house last month. So a pipe burst in my bathroom and water spilled into 4 separate rooms. So I had to replace the floors. I had to call a plumber. They brought in like 15 of these big drying machines. They have to dry the walls and the floor so you don't have any mold. And those machines are in the house for like 9 days, and it's extremely, extremely loud. And not only that, they have to take up, require special power. So they take up the outlets for the oven and the fridge and things like that. I mean, it was so bad that my kids and my wife actually slept at my mom's house during that whole period. Then you had to call my insurance provider. And of course, that's always a process. It wasn't actually too bad, but we had to have the floors ripped up. I mean, the entire floor, right? The entire floor was ripped up on, that first floor. It's a 2-story house. And we had to wait for those insurers to come, which, took a few days. Then you had to order a new floor and just, go to a shop and everything, which took, 2 weeks for those guys to get the materials and another week to install. So my floor was just a dusty pile of cement pretty much for most of August. And now after the floors are put in, we decided, hey, you know what? Let's paint the walls because, we have to paint all the baseboards anyway. So we said, okay, let's just, we'll paint the walls and everything. Need a paint job. So we decided to paint the bathroom, living room, kitchen, separate rooms. Now the color of my bathroom is doctor's office blue. And I call it that because my wife chose the color when I came home one day and she was like, oh, what do you think? I like it. I said, I feel like going to the bathroom in the doctor's office. So I call it doctor's office blue. And outside of the bathroom, our living room, we have an accent wall that used to be painted magenta, like a purplish red color. And it's just one wall in our living room. Getting to the point here. So we decided to change it. So, let's change it. It's a little bit dark. Let's change it to a nice grayish blue color. It's like, really nice, gives the house a beachy feel since, we're out close to the ocean. So my painters come in and I tell them, hey, I want the accent wall painted with a new grayish blue paint, right? That I actually bought already. We bought it 2 months ago. My wife and I were going to paint it ourselves, but we figured, hey, let's, let these guys do it. And I told them to paint the bathroom with the same doctor's blue color, right? So I had half a can left of that. So very simple, right? The other can was brand new. That's the grayish. That's what we want in the accent wall. And they're like, sure, Frank, no problem. We could do that. Now, my wife is always running errands every day. She's taking the kids to school, picking them up around 2 p.m., driving them cheerleading, gymnastic, music classes, chess. I swear my kids do more shit than most adults do in a lifetime. But they all, they love this stuff. My wife loves to keep them busy. Anyway, with me working and my wife, basically running around, the painters were in the house by themselves. So when we both got back around dinner time, we noticed something strange. The painters painted our accent wall with the wrong color. So they painted it Dr. Office blue. The color that, obviously me calling that, I'm not crazy about it. Instead of that really nice grayish, light blue color that we told them to do. What a freaking surprise, right? I got a quick reminder that we're in Florida again. Anyway, so they had to repaint the wall, and they're actually still painting my house right now, which I think they're on like day 5. So it seems kind of long to me. I think it's like 4 to 5 rooms, but 5 days of just, that's all you're supposed to do. Give me 5 days, I'll paint an entire house. I mean, if that's the only thing that I'm doing, I'm just surprised it's taking that long. But they come in at 10, have an hour lunch, smoke breaks, and leave around 4:30. That's kind of the normal here in Florida. Yes, I wish, and I know a lot of you wish you had those hours, but we don't. So when my wife and I saw that the color of the accent wall was wrong, we were obviously really ticked off. So remember, our house has been a wreck for a month due to that flood, and now it's taken another week or so to paint, and there's drapes everywhere, and the house is a complete mess. It gets to you in a while. Every time you walk through the front door, it feels like you're living in a shack because everything's just torn up. So, we're kind of losing patience as well. So my wife's like, whatever. She's pissed off. She's like, you know what? I'm going to run. I'm going to get a coffee. I'm going to go to Dunkin' Donuts. So she goes in. She takes the kids there. Decides, you know what? I'm going to move for a bagel. Dunkin' Donuts has been open for 8 years over here. And coming from New York, we love our bagels. Dunkin' Donuts don't even compare, but there's not a lot of place to get bagels. And, sometimes she'll be like, all right, I get a great bagel over there. That's fine. So my wife asks for 3 poppy seed bagels toasted. And Dunkin' Donuts, at least by us, never had poppy seed bagels. They never had them. So my wife said that by accident because, we love poppy seed bagels, which she meant to say was sesame. She's like, oh, I'm so sorry. She's like, I meant sesame. And the guy's like, no, we have poppy. And my wife's like, wait a minute, you didn't have it for 8 years. He's like, no, we've had it for the last 10 years. And she's like, oh, all right. She knows the guy's full of shit. He's like, all right. We've been coming here. I'm telling this. So she's in the drive-thru and she tells the guy, she's like, all right, just give me, 3 poppy seed bagels toasted then. So she gets home and she opens a bag and it's 3 toasted bagels and they're all sesame seeds. Now, my wife has a pet peeve and we all have them. So I'm not making fun of her. I hate when people wear those dumb neck pillows around the airport terminals. I don't care if you're wearing them on a flight. I get it, but I don't know. I just want to take it off and throw it down the terminal. For some reason, that just bothers me a lot. I know I sound weird, but we all have our pet peeves. My wife, her biggest pet peeve is when she orders takeout and if she gets home, the order is wrong. Now, imagine buying a brand new car and you just drove it to your home to show your family. You want to show it off. It's amazing. And before you even get to the house, another car comes roaring down the street, crashes it, completely totaling it. Think of how pissed off you would be if that happened. Now, times that by 100, right? That's how mad my wife gets when someone messes up the food order when she gets home. She goes crazy, which, by the way, happens like 75% of the time in Florida. She calls the guy at Dunkin' Donuts, gets the guy on the phone, and she starts kind of going off on him because the guy was a little obnoxious, telling her, we serve poppy seed bagels for 10 years. So the guy's like, I did give you poppy seed bagels. And my wife's like, there's sesame seed. And apparently the guy doesn't know the difference between poppy and sesame. Again, no surprise. But to see my wife's reaction is awesome. So this happened on Monday, and now we have yesterday, right? My wife's driving the daughters to school. Again, the house is still a wreck. She's still pissed off about the painters, which, she does and we do have every right to be. It's taken a long time. And after she drops the kids off, a few hours later, they call in and say, Brianna, my oldest daughter, has pink eye. We need to take her home. We don't want everyone else to get it. And I get it. I understand that. Like, if you have something contagious, I don't want, usually it's the right thing to do as a parent is, hey, if you got something contagious, whatever it is, a cold, sit them out for a couple of days. This way the whole entire school doesn't get it. I mean, it's different when you're really young, but she's 12 years old. So my wife's like, she doesn't have pink eye. We just have tons of dust in the house right now because, the sanding the walls and stuff like that. And she has allergies and she was rubbing her eye. That's why it's red. So the person at the school says, really? If she's allergic, then why is it only one eye that's red? So my wife's like we don't know our daughter, right? So my wife drives to school, picks up my daughter, notices the principal there. So apparently the lady at the front desk who told her this, who thinks my daughter has pink eye, told the principal, who was really cool, by the way, but she must have told her because my wife was questioning, saying, do we really have to take her out of school? And the principal was like, yeah, you should take her out of school, whatever. So wife immediately takes her out, goes right to the doctor. Got to pay $30, wait 30 minutes. Doctor sees my daughter and says she doesn't have pink eye. Right? So he's about to write the doctor's note. My wife's like, could you do me a favor? Could you write in big bold letters that Brianna does not have pink eye? She is not contagious. The doctor actually did that, like right on the note. So my wife's going to talk to the lady at the front desk again, which is today, and hand her that note. And I'm telling you, I wish I could be there when my wife gives that lady the note because my wife's really cool. She doesn't hold back. She's not fake. She doesn't like someone. She doesn't talk to them. If she likes you, she'll give you the shirt off her back. But when she gets pissed, watch out. I've been there. I know. It's pretty impressive, actually. It's really cool. Just like if everyone gets angry and pissed off. So I'm not picking on her because she does have every right to be really pissed. Anyway, sorry for the long drawn-out story here, but it's been really stressful over the past few months. We're launching several new products over the next 45 days. Got a lot to look forward to. Just closed our security token off for Curzio equity owners, so very busy at work, as you guys know, just like all of you are these days, right? We're all working hard for our families. But man, when you just throw in the family stuff and all things going on with the house, whew, gets a little crazy sometimes. I could see why marijuana is just getting bigger and bigger these days. People looking to relax and calm down. But it is crazy out there. Just need time to distress. And you know what? That's why I love this podcast. It's like therapy to me. I say it all the time. Just gets everything off my chest. You guys like family. You know everything about me. But now that I get that off my chest, sorry you had to listen to all of my nonsense and personal nonsense, which I share with you. But now I feel much better. And it's back to work. And I'm laser focused, which is a great thing for you because I have an awesome show for you today. Starting with my interview, my guest is Andrew Horowitz, who's a regular on the show. Andrew hosts the second best financial podcast in the world called The Disciplined Investor. He manages money through Horowitz and Company. Andrew's a good friend, brilliant analyst, awesome guy, and he is going to debate me on several big topics today, including tariffs, the impact of the U.S. and China, recession fears, the current administration, Donald Trump and his tweets. We had a couple of back and forths on Twitter, and back and forth, I mean, friendly debates, the way it's supposed to be. Not that I hate your freaking guts because you have a different opinion than me, or what we normally see in the media today, especially on the political end. Guys, pay attention to what we're saying. You're going to get two different opinions, which is fine. We'll see who's right later on, but you should take that in. You always want to hear both sides of the story. It's important. You always hear my side of the story. I have guests on. I love having guests that have different opinions because I learn from them. And sometimes they're going to be right, and sometimes they're going to be wrong. But I want you to look at this with an open mind and say you don't pretend that you know nothing about a potential recession coming, like the tariffs is new, or you don't have an opinion on these or where it's going, and just listen to both of us because we're going to make some really good points about how you should invest and if you have to change your asset allocation long term, because we're seeing so much freaking volatility out there, which is nuts these days, and a lot is being driven by these macro indicators. We're going to get into it really deeply today. Trust me, it's going to be fun. It's a good interview. I don't say that often. It's going to be really, really cool, and you're going to learn a lot. More important, Andrew's also going to share his favorite ideas, a few really interesting names, including one stock that he believes you should short right now. So really great stuff coming up. Then in my educational segment, I'm going to break down the new norm of algos. And that's algorithms. And if you're a subscriber to Curzio Venture Opportunities, you're going to be reading about algos, what they are, how hedge funds are using them to front run the markets, how they're creating more volatility in stocks than I've seen in my 25-year plus career. We're also going to read about how you can take advantage of this system and beat Wall Street at its own game. So I break all this down in CVO, Curzio Venture Opportunities, which if you're a subscriber, and that's the most expensive product we have here because it's really focused on unique ideas that we buy that you're not going to find anyplace else, and also private equity deals and stuff like that. But you should have that issue already. This is Wednesday that we're doing this, and it comes out Wednesday after the close around 5, 6 o'clock. This gets published around that time too, but you should have got that issue, right? Make sure you read it. It's really awesome. And in this educational segment, I'm going to go over some of those details. Some of the data is going to completely blow you away. So be prepared of how much volatility we have in the market, especially over the last 2 years. And you better be prepared, because if you're not, you don't adapt to the new norm of algos, or at least understand how they're being used, you're going to be left in the dark. And by being left in the dark, I mean you're going to have trouble generating market-beating returns without understanding the volatility these algos have created, especially guys over the past 2 years. And you know what? It's going to get a lot worse going forward. More and more money managers are turning to these quant systems, and more important, the largest institutions, sovereign wealth funds, teacher retirement, California teacher, all these firms, police, firemen, retirement funds, trillions of dollars is looking to flow into money management firms who are using these systems, whether you want to call them quant system, machine learning, algos. Tons of money is going into that right now. That's what they want. There's a reason why I'm going to break down educational segment. But you need to understand this part, because you're going to see tremendous volatility. It's going to get a lot worse going forward. So really great educational segment coming up. Definitely want to listen to it. But before we get to that, let's welcome back my buddy, Andrew Horowitz, who is about to debate me on several major topics. So again, it's going to be a really fun interview. Well, let's get to it right now. Andrew Horowitz, thanks so much for being back on the podcast.
Hey, Frankie Curzio. Frankie X Curzio, which I am thinking stands for Xavier. Am I right?
That's a very good guess. That's correct.
And what else could it be?
I know. What else could it be? Anything else?
Frank X-Ray Curzio.
Yes. Frank X-Ray. Yeah, right. There's not too many ideas. So not too hard to figure out. Now, we're going to have some fun because you and I debate in a professional way, guys. Andrew and I like each other. We're good friends, but we have different opinion on things sometimes. It doesn't have to be Democratic, Republican. You have to hate each other. So we're going to go over a couple of topics that are very relevant to today's market, and go over the points. And more important is we want to give you our take as individual investors of what you should do for your money, what you should be worried about, what you not should be worried about. So Andrew, I want to start off, and actually Andrew has a new soundboard, a new studio. I'm hoping that you're going to do it when I say the word tariffs. Can you do it for me on the spot? That's it, guys. We got to end right there. We should end it right there. So Andrew, let's talk about tariffs. I want to get your thoughts on the latest between Trump and China. It's in the news so much. More important, Should individual investors be concerned? And by concern, I mean, should they change their long-term asset allocations based on what's happening now? Something I thought would be over a while ago, but something I also said that keeping money in U.S. stocks, you're going to do fine. And they have done fine up to this point, which a lot of people were worried about millions of things. But this has lasted a lot longer than what I thought. What do you think is going to happen? What are you telling your clients?
All right. So let's just also recognize that the whole idea of the tariffs, the nature of tariffs themselves, or higher prices taxing goods and putting some kind of an extra price tag on goods is inflationary in general, or at least it should be. And that is either going to be absorbed by the company that is importing it or the consumer. So it's the priority depending on how things are going, and more importantly, how long these tariffs stay in effect. So if tariffs are short and companies are like, okay, we'll absorb it for a little while, not a big deal, but over time they're going to have to push that onto the consumer. So that's why we're not seeing a lot of inflation right now. In terms of the allocations, I mean, I would say at the beginning of the year, we've generally for our global allocations shift a little bit to the left in terms of safety, getting away from some areas around the world that were more concerning, extremely shortening up our bond exposure, which has been doing very well. And at the same time, depending on how long you're looking, do you want to say, well, if I have a 10-year horizon, does it matter? Well, maybe not. But I got to tell you something, the longer this goes on and the more escalation that we see in terms of the level of tariffs and the rhetoric, the more difficult it's going to be on the global economy. And then, there's this whole idea that, well, things are doing well in the United States. Yeah, we're doing much better and we're doing fine, generally speaking, from an economic standpoint. Not great in terms of GDP growth. Jobs growth is wonderful. We're seeing manufacturing slow down significantly. We're seeing some durable goods sell off and do better and very choppy. But, generally speaking, I don't see any real holes at this point in the U.S. economy. However, we are not an island alone. And the fact is that we built for the last 25 or 30 years, we built up a significant relationship with the rest of the world in the whole globalization process. And we're essentially trying to break that down in a matter of 4 years. And the way it's being done, the haphazard and I would say flippant way that this is being done is, I think, very detrimental to the confidence. And we don't have confidence, that's where things fall apart. So, depending on how long of a time period you have and time frame, depending on your risk factors, and more importantly, whatever your spook factor is, you may want to adjust your portfolio to bring down equity exposure just temporarily and look for an opportunity if we do see an economy rolling over, the tariff and trade war dispute expanding. But, it all depends on kind of where you are. And then you have to also look at what areas do you want to be in. Large caps are doing really well. Small caps are doing terrible. Banks are doing awful. Energy is doing terrible. So, I mean, it all depends on where you're picking your positioning, right?
So, Andrew, I agree with it. But for me, when I look at trade, I thought that this would end sooner. And the reason why I thought this would end sooner is because I look at the numbers, I look at the data, and China is getting destroyed. I mean, their GDP is at a 27-year low. If you look at their market last year, it crashed more than twice ours, and also rebounded twice our market when things and negotiations were going pretty good, right, earlier this year. So when I see the numbers in China getting worse, they have a mess. I mean, that GDP is what, 300% plus. I don't know how they could sustain that. But more important, you're seeing, like even Google announced, I think today or yesterday, that they're moving their supply chain out of China. And companies have been doing that. I'm listening to conference calls. They're moving, not entirely, but they just can't. It makes sense, right? If you're a company, if you have your supply chain in China and you're worried about tariffs, and based on every single tweet that Trump has, you're seeing you can't really run a business that way, right? Because you're talking about very, very high costs, a big percentage of their overall cost structure, and they don't want that uncertainty. It's kind of like hedging fuel costs for an airline, right? You just don't want that uncertainty where, it was $120, it was $29 in a 5-year period. It's crazy. So you want to hedge it this way, you can run your business. Mm-hmm. We've had different opinions where I said that this has to end. I was just under the impression that it would end. But you were like, well, there's a lot more to this and there's a lot of stubbornness. Explain that, because I'm hearing that a lot, even from people who listen to this podcast who are listening in China, because both of our podcasts are international. Explain that a little bit more, and this way we get the audience in.
So let me help you with something. Seriously, Frank, we go back a long way, right? So I want to tell you something. You're thinking like an American, which is fine.
Yeah,
because you are. You're thinking like an American, and it's very difficult to understand a different culture and their mentality. The problem is that when you have a culture like we have here in America, where, I can call you up and say, hey, I could pick up the phone and I could say to you, hey, Frank, I need you to do me a favor. This is what I need you to do. And you'll be like, okay, end of conversation. You wouldn't think twice about this, right? You call somebody in China or maybe in Asia, you have to start with pleasantries, a whole different way of being. You have to say, how's your family? Thank you so much for taking my call. If it wouldn't be too difficult, there's something that I would like you to do. If you could do it, but if not, I understand. But here's what I'd like, please. And of course, if you do so, I'll be forever grateful. Whole different discussion. You follow what I'm saying so far?
absolutely.
Next, you have here a hot-headed and very emotional and a very politically motivated president who is utilizing American process and at a New York level, okay, not a South Carolinian level, a New York level of trying to beat down another country, saying that, you know what, here's the deal, take it or leave it, otherwise screw you, we're not going to do business with you. You have China, who says, wait a minute, this is no way to talk or negotiate or do any of this. And in a way, it looks like we're trying to conquer them on trade. Now, let me just back up and say one thing. You and I are both in agreement about, yes, there needs to be reforms. No question about that. And we talk about the intellectual property. We talk about the unfair trade and all that. So, okay, put that aside. We both agree with that point. It's the process as to how we're trying to turn this around that's the problem. China was conquered year in and year, for decades and centuries. As a matter of fact, in the 1800s, you had the Opium Wars back then. I was in China. I've talked to people in Shanghai about this. And you had something that was called the century of humiliation, a time when they were just conquered and people came in over the 1800s, where they came in and they had these they were forced to weaken the Chinese government, weaken the Chinese economy, to cede territories and sign these unequal trade agreements. And then what happened was that once that passed and once they got beyond that, they decided they are never going to let this happen again. They will never be conquered from a land-based conquering or an economic or a psychological or any other way. And now what's happening is they're getting a taste of this again, and you have a different culture, and it's coming at them hard and fast. Whereas, by the way, we set up a lot of this in China over the years. We wanted to be in China. We wanted cheaper products. We wanted to have cheaper labor and manufacturing. We set this all up, and now we're like, hey, you know what? This isn't fair anymore. We want it back. So there's a kind of a psychology that's going on here that I think is the basis of the problem. And on top of that, whether they pulled out of the trade agreement, whether we changed the rules, who knows what the real answer is here, right? Because there's so much going on between tweets and news and headlines, and then you got Fox and CNN. Who knows what the real truth in all of this is? And you have, China's newspapers and all. So the problem you have is that. And then on top of that, you have a political issue that's a really big problem. Trump's in his position for 4 years and potentially 4 more, but 4 years right now. 2.5 years into it or so, he has to start now making good on some of these promises and making sure the economy stays good and all the other things related to his attempt to tame this, this China economic situation. And he has the potential to lose political points if this thing doesn't go right, or if he doesn't close the deal, because he's the greatest deal maker in the world, the greatest and smartest deal maker that ever was. So he has to prove his point here. On the other hand, the president of China is now in for life. And more so, now all of a sudden, there's been some discussion about, I think the word is Ling Xiao, if I'm pronouncing that correctly, which means spiritual leader. This is coming into the discussion and vocabulary describing Xi Jinping or in terms of his heightened level of overall power. Not just the president, not just the leader, not just the premier, not just the the leader, the emperor, whatever, but now kind of at the next level spiritually. This is in the news the last few days. And now you have a situation where he's in for life. He doesn't have to worry about losing political points. They're looking at him as the chosen one, really, in China, whereas President Trump was saying it about himself, laughingly maybe. So you have this weird situation, and this is why I think this is going to be a much longer process. And you just look at what happened last week. 8:02 in the morning on Friday, China comes out and says $75 billion of increased tariffs on $75 billion worth of goods going into place on September 1st and December 15th to have a reciprocal and direct tariff as we're doing it moving forward. They're not backing down either. And what do? They manipulate the currency down. The yuan is down 14% since the trade war started, defraying some of the costs on the goods, right? Not really great for them. So I think that there is a lot that's going on here, and you're starting to see a lot of manufacturing slow down here. It's coming in and we're importing the slowdown to a degree. We saw that the market PMI index, manufacturing index, the flash number came out last week below 50 for the first time in a long time. We'll see what happens with the actual ISM numbers. But yeah, I mean, I think that we have to realize that this is not going to be a short-term process. And I would, if I was a gambling man, the under/over, this is not going to be resolved before the election.
No. Well, you said a lot of things there. 'Cause one of the things you said, you mentioned looking to conquer China and going back to the opium wars and how did you put it? Where it was like a century of humiliation, I think you said. So when I look at that, and because this is what I mean when we see media and we see people take things, just go with it and run with it and go crazy with it. I mean, we're comparing the opium wars, right? I mean, even if you look at the second one, it's not even close to a comparison to what's going on today, right? I mean, you're looking at part of the treaties open up China to British merchants, drug traffickers, cartels pressured London into demanding Beijing pay them full street value for all the narcotics that they did that. China said no way. They seized British ships, confiscating the opium, burned their properties, and then the British troops wound up slaughtering millions, I think, of Chinese civilians, right? I mean,
got them hooked on opium.
Yeah, I mean, real quick, right? So I understand that. I understand that. But we're not asking China to sell more of our illegal drugs. We're not asking them to change their way of living or change their military, anything structural, right? We're asking them to stop stealing our shit, basically, and lower the trade balance a little by buying more of our goods, soybeans, agriculture, natural gas, oil, to make it more fair. That's what we're asking, right? Especially the intellectual property, which that's factual. Everybody agrees on it, both sides. You want to clean that. That's what we're asking for. We're not asking for, hey, allow us into your nation. This way we could take it all. It's not that crazy, right? So when I look at this and see what's on the table, and I look at China, we're a 20% customer of China, by far the largest. I mean, if you take out Hong Kong, which is basically China anyway, I think the next largest is South Korea at 6%, and Japan at like 5 or 6%. So if you're a company, think if you're a company and you lose your 20% customer, that's not going to happen. It's not going to be all or none. But what's going to happen? I mean, where do you sell those goods to? Who's China going to sell those goods to? We could buy them. We could buy them from anywhere. We're going to pay more for them. And there's people lined up around the block, other countries, Taiwan, Vietnam, that would produce this stuff like crazy for us. I mean, the amount of money that they're going to make is going to be insane. But we're going to pay a little bit higher prices. So, if you look at the numbers of what's going on in our economy, we're 5% off our highs, whatever. Yes, we have a whole bunch of fears and everything. China is in a depression. I mean, their GDP is at a 27-year low, like the growth, right? So that's how much they've slowed. If you look at the numbers and the massive amount of debt. So I understand the culture, and I understand that, hey, the president is in for life. So he's going to sit on his hands, right? That's what people are saying and saying, whatever. Does he really want to be the person? Because now you're seeing companies actually move out of China. Okay. It's not like, hey, if this thing gets resolved, everything's okay. No. A lot of companies are moving their operations out of China. Yes, that's going to start hurting us. It didn't hurt us last year because we had the tax cuts, and I get it. And it will hurt us a little bit because we're going to have to pay higher prices, more inflation. But it's going to destroy China. I mean, does he want to be the guy that destroys 25 years of economic prosperity? Is that how he wants to go down? I don't know.
What I'm asking you is, if it's all that easy, Frank, if it's so simple.
Oh, it's not easy. I'm not saying it's easy.
Let me ask.
I'm
let me
saying
rephrase
what we're asking.
If you're saying we're not asking a lot, which we are asking a lot in certain areas and not in others, I get that. Okay. And by the way, I agree with you some of this. What is the freaking problem? Why can't we? What's the problem?
I think it's stubbornness between just one is we're not seeing China really buy our agricultural goods like they say. I mean, we've signed so many different things with them before, and they reneged on a lot of it. I'm not picking on China. I know I have a lot of people in China, and I know how aggressive and how crazy Trump could be, right? But that's how he is, all right? That's not going to change, and same with China. But when you're looking at these economies, let's say if this goes on through the election, where's China going to be? And you bring up something with culture, and I understand. I've been to China. I have a lot of contacts in China. I understand cultures, and I respect all cultures. But when does it get to a point where your generational wealth trumps culture? Because people's home values are going down 30, 40% now. They're losing jobs. Unemployment rate's going to go higher. They're not going to be building as much. They're manipulating the markets again, lower their currency tremendously. So when does it come down to people say, hey, could you, because again, we're not asking for major stuff here. That's why for me, what's on the table, and you can go behind the scenes and how many things they could do behind the scenes, things that we couldn't even dream of or think about, right? To get this solved, just like we did in the Cuban Missile Crisis and removing the missiles out of Turkey. Most people don't even know that we have missiles, whatever it is. For me, I just cannot believe that we cannot come up with a resolution because it doesn't seem like both sides are asking that much. But when I read the media and look at it, it just seems like it's crazy. And then you have Trump with Twitter pushing the issue, being an ass, and just saying, oh, I got to push more tariffs on you, which is basically, it's a $15 trillion economy and it's 10% of $300 billion in goods, which is nothing. I'm just surprised that it lasted this long. And my take is China would be crazy to wait till election because it's going to get a lot worse for them. You're taking a 20% customer away right now, and our companies are starting to adjust. And where are they going to pick up the balance in that? Because all the rest of the world is really seeing slower growth. I just think China has a lot to offer us, and we have a lot to offer them for this deal to actually go through. And plus we have an election year. I don't know. You may be right. You've been right in saying I thought it would end 6 months ago, so I didn't think China would do this to our economy, but they destroyed a ton of generational wealth. And
it's
that's
not just
okay.
China. Wait, it's not just China. Look what's going on in Singapore. Disastrous.
Yeah.
It was a shipping hub of Asia. Look what's going on in South Korea. Horrible. Japan. I mean, and let's not even talk about what's going on in the bond universe. That's a whole different discussion here, right?
Well, let's get to that discussion because
before we do that. Yeah.
I love that. Don't make me get a sounding board. They wanted me to do that with Kramer if I took over his podcast. And I said, no, I don't want to be exactly like Kramer. I said, and they were like pissed at that. But yeah, that's pretty cool. That's funny. I love it. So listen, that guys, and take everything what Andrew's saying. I'm saying again, it's your portfolios, it's your money. For me, I think we're on the same page where we think that, the market's going to be okay. And we're going to get into that now. We'll talk about recession because recession is the biggest. Again, you guys know how we feel in tariffs. So let's move on and get to the recession, because the recession argument, that's the most used word in financial media right now. And like you said, 17 trillion in government bonds and now have negative yields, inverted yield curves everywhere. Europe slowing. We know China is slowing tremendously. So earnings growth, weak manufacturing. What are your thoughts here? Because you also mentioned some positives, and we don't hear the positives in the market. People don't want to hear the positives. They don't read about that. That doesn't generate page views. But, we have much. The Fed's going to lower rates tremendously, right? Possible resolution on tariffs, maybe, who knows, before the election. We are heading into election year, and our president's going to do everything he can, like you said, and I agree with you 100%, everything in his power to keep the markets up, right, including influencing the Fed as much as he can. Consumer spending is solid. So there are positives, but there's all negatives, and it seems for our markets, and because you've been doing this for over 2 decades, Andrew, and probably over 3 decades, when you have like a Goldilocks economy, not too hot, not too slow, you measure a lot of these risks and a lot of the positives, that's usually when our market performs best. But what are your thoughts? Are we headed? It's a tough question because a recession, recession is defined, as 2 straight quarters of negative GDP growth. But if we grow 0.1%, that's a recession, right? Even though it's not negative technically. What do you see on the horizon, and are you worried about a recession?
So one of the things that I'm worried about in the terms of recession is our ability to talk ourselves into it. And what I mean by that, it looks like it's becoming a bit of a self-fulfilling prophecy. Just yesterday, I did an analysis of a Google Trends search for the word of recession back to 2004. And it goes on a scale from 0 to 100, being the most utilized search term for the time period for that term. And you can see a chart of this. And back in 2006, 2007, it spiked up to about 100. In other words, during that time period, from 2004 till now, the most used search term, or the frequency of the search term, was at 100. Then it backed off a little bit back in 2009, 2010. It came back into the 80s, and then it kind of petered off, and it was not used at all to speak of. I mean, a little bit here and there. We just spiked to 87 in the last 2 months. So that means there's a lot of search going on for the word recession. And, so people are now all of a sudden very sensitive to the idea. And why? Well, somebody came up with this whole discussion about the 210s inverting, the yield curve inverting, the rest of the world in recession. News media picked it up and they started just flying with it. The recession signal. And look at this and look at that in the trade war. So all of a sudden it's everywhere. Are we going into recession? Could we be going into recession? What are the recession odds? And you see this now all of a sudden it's becoming into the vocabulary, the search of individuals. And the problem with that is this. If you didn't know this, if people out there listening didn't know this, the stock market and the economy is all a confidence game. And I don't mean that in a negative, like con game, but it's right. It's all about confidence. And if you have, for whatever reason, a great economy, great earnings, and for some reason, investors and consumers lose confidence, all bets are off. Because what happens is if they think that there's going to be a recession and they start planning for that, or at least gets into the back of their mind somewhere, and they're like, okay, let's go buy that car. Oh, you know what? Maybe I shouldn't buy that car. Maybe I shouldn't buy that house. Maybe I shouldn't buy that. Maybe I shouldn't spend so much at dinner. Maybe I should sock some money away. Maybe I shouldn't be so highly allocated to stocks. And that's what we're seeing. We're seeing that individuals have pulled record amounts of money out of equity funds over the last several months, seeing the highest level of money market balances. Now, some people say, well, that's money on the sideline, just looking to get put back in the markets. Maybe it's possible, but there's something going on.
Before you go any further, too, don't forget that everything is bad that happens is also good, because that means the Fed's going to lower rates, right? But like you just said, I'm kidding, but just like how people interpret different news. Gotta keep going.
But it's funny that you mentioned that, because when confidence is down, if the Fed drops rates, that reverses that concept. People are like, well, you know what? That confirms their worst fears. Oh my God, things must be bad.
Yep.
So, while you have those people on TV giving excuses, a lot of rationalizations these days. Have you noticed? Hey, don't worry, we got $17 trillion of bonds that are now negatively being issued at a negative rate. Well, that's just because the experiments going on in Europe and this. We got $1 trillion of corporate debt that's now at negative yield. That's amazing.
Yeah, even like the latest, this was yesterday, I think it happened, where the 30-year Treasury yield is falling below the yielding S&P 500. And this only happened one time since whenever they've been tracking this. It's 40 plus years. And the last time it happened was late 2008. So the person who actually posted this, I saw it, it's, a research report, a sell-side research report, but he was talking about this being a negative. And I was like, yeah, it's just how we interpret news. Because I'm like, well, is that a negative? Because the last time that happened, if you bought stocks, then you'd be up over 200%. Yes, you would have had, a period where your portfolio would have declined around 30% through March. But if you bought stocks then and held them to now, does that mean that's a buy? And again, our market's at a high, and back then they just crashed. So it's different. But it's basically the way you interpret it, and all the, yield curve inversion. There's so many things out there and so much noise. But I think you're going to agree with this, Andrew. Recession isn't the worst thing in the world. It's not a bad thing. Look, it happens. We slow down. It's usually a good time to find great names. It's not a depression. And I think everyone has in their mind, because we haven't seen a recession since the credit crisis, right? Mm-hmm. That it means, holy cow, that I'm not going to get paid from my company anymore. All debt is frozen. And I think people have that in their mind where, oh my God, because for the market to fall 800% simply because there was an inverted yield curve.
800%?
800%. It fell 900% now. It fell 800 points in one day.
Okay, there you go.
Right. This was last week. Right when the 2-year and the 10-year, I think, inverted for minutes, and then it didn't even close like inverted. It crushed the market 800 points. I mean, a massive, massive move for something.
Well, that was the algos. That was an algo trade that said somebody programmed in, if the 2-year ever gets above the 10-year, you know what, we're going to sell this position in equities. And it just, you know, with the limited amount of volume, less participation in the markets, primary driver of stock being buybacks right now, it just overwhelmed the market. So that's what, you know, happened there, I think.
And I'm glad you brought that up, because I'm going to have a whole educational segment after this about the algos. And maybe we could switch tunes here, because I agree with you with the recession and the risks out there. But how, and I love talking to you about this because you're a great trader. How are algos impacting how you trade now? Because the last 2 years, it's been insane, the volatility. Yeah. You're seeing stocks that report bad earnings that are down 7% to open. They finish down 25%. Or they'll finish up, you know, if they report good earnings, the stock will be up 7%. And the thing is all the way through the roof, like 15, 20%. And I'm not talking about short covering. It's not big, you know, a lot of shorts, the percentage of the float that's short. How are you adjusting? Because these things are blowing past moving averages. Have you adjusted being a trader to these massive, like you said, oh, well, that's just algos. Yeah, you're right. It's algos, but it's an 800-point move. I mean, that's significant just for algos. And what happens the next day is it rebounds 200-300 points.
It's a problem because you have to obviously widen your stops, make better calls. It kind of sharpens you a little bit to try to figure out, you know, what stocks you have more confidence in and look for those levels that would be supportive. I mean, some of these algos are very basic. They're just, okay, they touch the bottom end of the range of the day and we start buying until that fails and we'll drop it down. Or, you know, you get to the top, tick it down, short it at that point, and then we'll see if it kind of follows through. If it doesn't, we'll buy back. That's why you see also the reversals very significant, because the positions are being unwound and redone each and every time. So it is a problem for that. I mean, when it comes to individual stocks, if you're buying individual stocks for a reason, for a fundamental underpinning, and you don't see exactly necessarily what's so bad about what's going on and why there should be a 25% sell-off if they've met earnings, but guided down by, you know, 2 cents, a cent, whatever the number is, right?
Yep.
You know, then it may be an opportunity, and that's what happens the next couple of days. A cooler heads prevail, and they start, you know, buying in. So on a, you know, swing trade or a short-term trade basis, I think you have to be a little bit more, I don't want to say patient, but just more aware. Widen your stops out on the trading basis. But yeah, it is become very volatile, but it feels much thinner. Markets feel much thinner.
I agree. I mean, it's just you're buying stocks, and even small caps have been decimated. It's amazing. Like, you really don't see that big of discrepancy. I think it's the biggest in 20 years, the difference between large caps and small caps. That was about 3 weeks ago. I don't know what it is now, but just how much large caps outperformed. Yeah, outperformed small caps. And you're seeing so many names on no news, like, really fall, and they'll report earnings will be decent, and maybe it'll go down 2%. Next thing you know, next 2-3 days, it's like 15, 20% selling off, you know. So I guess I'm asking you, when you see these sell-offs and you're looking to get into some of these things, usually traders have tighter stops. Maybe it's 5%, maybe it's 7%, maybe it's 10%. I don't know. But we're seeing the markets move. I mean, these stocks move 20%, right, in trading range right now. So that's got to be difficult, because you're probably trading even more in and out of these things a lot quicker, I would think, right?
It's potentially, yeah. I mean, I really like to find some basing patterns in this kind of market environment, where you find things that have fallen down, not catching a falling knife, but a basing pattern where you see it really holding a good level of support, volume based for a period of time. And then all of a sudden it starts to see a little bit of momentum move from some of the indicators that we built. And then you start to see that this turnaround happens. Look for those gaps that are looking to fill. Those have been, you know, to this day, the market has still been, in my opinion, generally speaking, very kind to move stocks up off of a low. I mean, you look at a company like a stamps.com, stock fell from, I don't know, some ridiculous number it was, I think, 150 down to like 60, then down to 30. And now it's rising right back up again, even though they still don't have the U.S. Postal Service deal. So, you know, why are people getting there? I mean, there's still a lot of really significant amount of confidence and baked up speculative action going on in markets. And I think that is, you know, helping to hold things pretty well. You know, you just look at Facebook. Facebook is... Before
you get to Facebook, too, I just brought up a chart of stamps.com, guys, and definitely take a look at it, because you're talking about a stock, and again, I know they lost that deal. The 52-week high and low is 256 is the high, 32 is the low. So it was, you know, 256 around a year ago, They lost these deals. It came down tremendously, but it fell. And this is what I mean, where it fell like 87. You're like, wow, went 250 to 87. And you think, wow, okay, traded at a good level. Then it crashed again to like, the third, what is it? The sixth, I don't even know where. So the 30s, but now it's up 100% off of its lows. So when do you figure out? Because it looked like, wow, 70 was a level, 80 was the level. I mean, that's how difficult this market is. I've never seen anything like this in my 25-year career of how crazy these stocks move.
I think it's because there really isn't a lot of participation from individuals. I think it's ETFs. I think it's mutual funds. I think it's buybacks that are buying shares. I think it's algos that are running things. So therefore, you don't have that middle fat, if you want, that protective level.
And you're never gonna get it. I mean, 80% of the trading is machines, right? Now it was 15% in 2000. Now it's 80%. Right. I mean, it's not going to change, right?
I don't think so. And I think that the more volatility you have, the more it spooks people out of being in the market. And not everybody. I'm not talking about your traders. I'm not talking about your people that are investors that really believe in it and all that, until something really ugly happens. But at the same time, one of the things I think is a problem is we're in this world of buy the dip and the constant rebound and the one day down, one day up, one day up, one day down. And everybody's, and we're staying in a pretty good consolidation range right now. And, we'll look at the rest of the world. Again, we're saying, Brexit's on the horizon. We got these, negative yielding debt. We have a massive amount of debt pile in the U.S. We have Europe near or in a recession. All these things that are going on. And we're ignoring some of that, I think. And I think that is because there's not a lot of people to spook out of the markets necessarily anymore because of the way it's being held up. And so it's a little bit of a different environment. It's going to be a little bit more in tune with the fact that you're playing chess against a machine now. You're not playing chess or you're playing poker against a machine. So understand that there are some moves that they're going to make that are pretty much scripted versus emotionally driven.
And they're going to make them I'm not even saying this as this is an actual a million times faster right now. And it's going to get faster with 5G, but they're making it so much more faster than the human can possibly process all this stuff. Yep. It's getting faster and faster, which is crazy. So, yeah, I'm glad you covered that. I wanted to get your view because I'm going to cover that later in my educational segment. But just from a trader's point, I appreciate that. I love the basing pattern. I love that. So let's get to the fun part, which is, we're talking economics. We're trying to make it interesting and have different opinions because it is related to the market and moving stocks. Those are big topics. But let's get down to individual stocks, which people love. You have a couple that you usually send me a couple bullets of things that you want to talk about. And you're very high in the home fitness market. I thought that was interesting. Could you talk about that a little?
Well, no, the home fitness market, I'm thinking about shorting it. You have companies coming out like, this product called Mirror, Peloton, which I know you have a couple of those and you do this every day because you're a big
of course,
sporty guy. Yeah, you're
me, yep.
pedaling at 150 miles a day.
You're right.
Yeah, you're on it right now. It's powering your podcast powered by Peloton. You're pedaling and it's running this thing.
Can I tell you a quick story? Quick story. So when I interviewed Jim Rogers, this is about 5 years ago, he started like this exercise regime and he was doing the interview on the treadmill and he lost his breath and started coughing and he couldn't stop. I'm like, are you all right? And he's like, oh, I can't. I said, look, I'm going to be honest with you. You dying on my podcast is going to get me a ton of freaking downloads, but I don't think it's a good idea. And he just
how great was that? Oh, yeah. How great was that?
We had to stop and enjoy it. But anyway, no, I'm not on my treadmill right now. Go ahead.
But there's the Tonal, also these home fitness gyms. Now, some of them are a little bit expensive, $2,000 for a Peloton, $40 a month for the subscription. But I'm thinking, there's a company called Planet Fitness, one of probably the only fitness companies I've seen in a very long time that's done so well. But, they're doing well in an economy that we have a lot of jobs growth, which is good, general confidence, which is good. People want to go and exercise and all that good stuff. Okay. Now, what happens when they have this opportunity and you have a Peloton come out or a Mirror that, Peloton's out, but a Mirror that people are really going with, and this expansion of home fitness where you have the opportunity to be social at the same time. So a lot of the part of going to a gym is, there's some social aspects to it, right? So you get to be in a clean bathroom that doesn't stink from underwear. You get to be in your own home with air conditioning, whenever you want to do this, morning, noon, or night, late night, whatever. Yeah, you pay something for it. I'm thinking, Planet Fitness, the stock is looking a little like it's rolling over here. So I thought that was an interesting short candidate in this big picture of the home fitness environment and possibly looking at Planet Fitness as maybe something that won't do as well if it really takes on. Just something to think about.
Yeah, no, and I thought you were kind of like high in them. I know you were short Planet Fitness and think that, that chart looks a little bit vulnerable. But yeah, I didn't know that. I thought you were kind of thinking that, that market was really good, which is surprising. But let's get to something that you really like here, which is Luckin Coffee, which a lot of people don't talk about, off everyone's radar. I love your thesis on this, actually. I started looking into the stock a lot. Talk about why you like that.
So one of the things that we've talked about at the beginning here is this whole trade spat dispute, this kerfuffle, this trade war that's going on. And one of the things we're seeing is a little bit of anti-American psyche that's growing in China. Well, if they're going to treat us like that, we're not going to buy their products. So in China, they have, of course, Starbucks doing very well. Well, they have another chain that opened up called Luckin Coffee, symbol LK. And the stock IPO'd, a few months ago. And, generally speaking, it's losing money. But again, I think that Starbucks got the Chinese market hooked on coffee away from tea as much. And the opportunity for them to step in behind Starbucks and really pick up a lot with the idea that the Chinese will say, hey, I want to buy Chinese. I want to buy a coffee from my own country, from a company that's in the country, is something that's pretty appealing. I think it's kind of interesting. And, if you can get it below 20, better below 19, I think it's a good play. We traded this back and forth several times with some very good success. And I think there's an opportunity here, especially you start moving up and over that break point when it came off of, I think, 25 or so. This thing could really jam up pretty well. So I think there's a interesting thesis on this and an opportunity to on the long side.
And then finally, another name that you mentioned, also a play on China, Wyndham Resorts. So talk about that a little bit, because just when people see Wyndham Resorts, at least when I see it, I think of, timeshares, Florida, and things like that. But you have a different angle, a China angle here.
I mean, there's some exposure in China, and I think what I found interesting was I looked at the chart and I saw that when the Hong Kong protests broke out, there's some concern about tourism in China, and with exposure, just generally speaking, in that area, that there may be some concern about the lack of tourism for a period of time because people are scared away, rightfully so. And the stock really came down. They increased their dividend recently. Their earnings came out. Their earnings they beat. They did pretty well. There was some softness in the area on the outlook, but generally speaking, again, that was due to this problem in Hong Kong and all the protests, et cetera. So the problem is, even if it resolves today, are tourists going to go right back? If it doesn't resolve, by the way, you can have a really big problem, because you're going to see financial firms and major institutions moving out of Hong Kong, not wanting to have to deal with this stuff. That's the one risk that you have there. I think it's a longer term idea. I think the pricing is reasonable on this stock, and symbol WH. I think there could be a long-term play, especially if we do see that there is some kind of resolution calming in the Hong Kong protest situation, the umbrella protests. What's going on there? So something to look at.
No, love it. Shared a lot of names there. So, short the home fitnesses like Luckin Coffee, Wyndham Resorts, definitely take a look at. So, Andrew, we covered so much, which is awesome. And I love that. I love having you on the podcast because we can go anywhere and it's relevant to everything that's going on right now. So if someone wants to learn more about you, how could they do that?
Very simple. You go over to thedisciplinedinvestor.com. All the different strategies that we manage there, from our TDI managed growth strategy, which is a long, short strategy where we utilize core. But can I mention something to you? I got to mention something here.
Sure.
Every quarter we rotate our stocks. This is something this is really important, actually. Every quarter we rotate our stocks. We go through 5,000 stocks. We do a quantitative screen. We look for earnings growth. We look for revenue growth. We look for margin expansion. We look for relative numbers according to the peers, 15 or 20 different components that make up this screen. And what happens is that we get a number of stocks that come out of that screen. And what we do from there is, let's say we have 50 stocks. We have, depending on the exact strategy and direction of markets, but we'll have at least a 50% allocation to the core equities, okay? If we have 70 stocks, we'll have 70% allocation. We just in the last quarter, July 31st, when we did the rotation, only 30 stocks made it through that screen, which is telling me that stocks are no longer able to keep up with their earnings growth. Maybe it's their ROE is a little bit lower. Maybe their revenue growth is tailing off. Maybe margins are compressing. Something is going on that stocks are not able to meet this high level of screening criteria that we put on, and therefore we have a much lower exposure, which has worked out very nicely in the last month, of course.
Yeah, definitely last month.
But I wonder this. I've only seen this once or twice before in the last number of years, and each time it's been a really interesting precursor to some stuff coming.
Negative stuff coming, or
yeah, because why else would stocks not be able to meet earnings growth criteria?
Yeah,
or revenue growth. Earnings growth is one thing. but revenue growth. The revenues obviously can't be fudged as much.
Yeah,
unless you're Disney.
Disney's in trouble, man. I'm telling you. Could you tell me? Let's finish with this. Could you tell me why the entire world wants to get into streaming when there's not a company in that industry that can make money from it? I mean, Netflix is not going to make money off streaming forever, and that's okay. That's their business model. People understand original programming. That's fine. You analyze companies different ways. Disney is not a company that's used to not making money. You just spent $71 billion to acquire Fox Entertainment's assets. You spent another, $1.5 billion to AT&T to increase your stake in Hulu to like 60%, and Hulu's losing $1 billion a year. I mean, you have all this content, and you're spending. How are you going to make up $71 billion by selling a service for $15 a month? You better get 10, 20, 50 million subscribers, but you're competing with hundreds of I mean, ESPN's a big deal because that's the biggest deal with streaming and sports. And that's, a lot of the companies lack that. But, I don't know. I cannot believe how many people are just going into this industry and overspending on every single thing they can content wise. It's just crazy right now. I'm just surprised.
I think it would be a lot easier just to buy all of Hulu and, work that with all the Disney stuff through there. Right? Wouldn't that have been easier? And
they own 60% of it. So, yeah.
Right. So they could have bought the rest of it and be done with it. They had the whole platform. It was done. But I don't know. It's pretty amazing. I don't know what's going on with the current claims about them double dipping on their revenues and all that kind of stuff there. Obviously, they have some great content with Marvel and all the other things and ESPN, blah, 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 the whole list. I don't know how they're going to make money either. It seems like everybody wants to be streaming. And, it's only so much room. Something's going to have to give somewhere.
Yeah, it's such a saturated. Like, people don't realize if you have Roku or something. I mean, every time I can't even get the setting off there, but it automatically downloads new streaming channels. And there's probably several hundred now. And, just focusing on live music and documentaries and all these different
Curiosity
topics.
Stream.
All this stuff, right? I mean, it's pretty cool. But how many services are there? It's, people think, oh, well, it's Disney and it's Netflix and it's Hulu. No, there's hundreds of companies now doing this, and hundreds, it's going to be thousands of services. But I haven't seen anyone yet make money off this. And again, that's okay for Netflix. That's the way their model's built, and people are fine with them not generating profits. I don't even think if they did their own discounted cash flow model, they wouldn't generate profits in the next 7 years. But Disney is going to be losing you got to lose a ton of money on this business to make it work. And for Disney, that's not their model. It's not why people buy Disney. And it's going to be interesting to see that transition. I know they're looking for growth, but you have to pay for that growth, and they're paying a fortune for it. So I don't know, pretty crazy.
I agree. This mentioned, so you can go over to thedisciplinedinvestor.com and you can check out all the different strategies. Of course, you can follow me on my podcast, which is The Disciplined Investor. But there's also stuff about there, our robo-esque type advisory platform. Investology's on there. So just go over to disciplinedinvestor.com and sign up for the newsletter and all that, and you'll get all sorts of goodies from us.
Awesome. And before I let you go, one more time, you got to do it for me. That is all. You're going to make me get a soundboard now. Oh, you're killing me. You're freaking killing me, man. That's awesome. So, Andrew, listen, thanks a lot. I know my audience loves you. Again, we're able to talk about everything, and you're real as you get. So, I love you coming on. I really appreciate it, man.
All right, bud. You're the best.
All right. Talk to you soon.
Love to the fam. See ya.
Great stuff from Andrew. If you're going to take anything away from that, it's the soundboard, right? How Kramer said soundboard. Okay, they wanted me to use that like early on with Kramer, and he just started, I want to say I helped, but there's a couple things on there that were my suggestions, because he just started the show when I was there, when I was working for him for that like the 4 or 5 year period, and just new ideas and different things, different, markets that we had to cover everything, but it just blew up so fast, the show. And thinking the soundboard and what sounds does Kramer say that we could use, buy, sell, whatever it is. And it's just funny. I was like, I don't really want to do it, but it's, if I took some of the things that I'm that I'm saying and the words that I think it'd be pretty funny if, I did get a soundboard these days. But anyway, I'm joking that that's all you should take from that interview, because we really covered tariffs and death, recession. I cut them off a little bit because at the topics off a little bit because I wanted to get as much in and get to the stock picks, which I know you love. But you heard two different opinions there on some of the things, and just take it, learn from it, and you want to welcome not as much information as you can, because there's a lot of noise out there. But Andrew's been in this market for a long time. I've been in this market for a long time, and now you have two separate opinions, and I think. Overall, we came to the conclusion that, hey, if you have a long-term perspective, then guys, don't change your asset allocation. And also with algos, which he touched up a little bit on, which I'm going to go really detail in a minute, it's going to create tons of volatility going forward. You need to be prepared. So I love that interview, but I always say this podcast is about you, not about me. Let me know what you thought. Frank at CurzioResearch.com. That's Frank at CurzioResearch.com. Now, let's get to my educational segment. Andrew and I covered a lot of the risks in the marketplace. Global debt levels are soaring. Most major emerging economies are slowing. There's tons of them, right? I mean, you hear about them all the time. But central banks around the world aggressively lower rates, 17 trillion government bonds trading at negative yields. That's an indication of extreme fear. Investors are desperate for safe haven assets. Geopolitical risks in the Middle East. Federal Reserve seems to change policy every quarter. I can go on and on, about the risks. President, Twitter, all that stuff. But as you know, what I taught you is if we're talking about these risks, that means they're priced into the market. They are. We're talking about them. What's not priced into the market is what you don't see. That creates danger. Okay. And one of the biggest risks to the market by far is algorithms. That's what scares the shit out of me. All this other stuff, we see it coming. If worse comes to worse, if our economy starts falling into recession, Trump's going to say, okay, we signed a deal with China. We're going to lower rates to 1%. That's factored in right now. That's really going to stimulate the economy. I'm actually bullish on stocks through the election because there's a lot of things we could do, and we're going to try to keep that economy, at least Trump is, because he knows an unemployment rate at nearly zero. It's never happened in the history of this country when unemployment rates were this low that that person didn't get reelected to a second campaign. Again, that could change. I don't want to get political. I know people hate Trump, love Trump, whatever it is. But for me, when I'm looking at interest rates coming low, I think it's a good market for stock. But the biggest risk, I think, is the one you can't see, and that's the algorithmic evolution. Now, algorithmic trading, algos, is a process of using machines to automatically execute trades. So these systems, used pretty much by the top hedge fund managers with hundreds of billions of assets in management, they can execute millions of trades in seconds. So basically, they're designed to take advantage of short-term inefficiencies in the market. What that really means is these systems don't care about who runs the company, how much money it earns, how much cash flow it generates, how fast sales are expected to grow. No, they're designed to make profits buying and selling stocks in nanoseconds. 15 years ago, this wasn't a big deal. I mean, algos accounted for 15% of the total volume in U.S. markets. That was in the mid-2000s. But algos now account for 80% of all trading on U.S. exchanges. I brought up that number really quick in my interview with Andrew. But 80%, we're saying again, of all trading U.S. exchanges is algos, machine trading. There's no secret. More and more hedge funds are adopting this method of trading. Explains why we're seeing an unprecedented increase in volatility, especially over the last 2 years. You want proof? Here you go. 2018, Dow Index swung by more than 1,000 points in a single session 5 separate times last year. You want to put that in perspective? That's only happened 3 times in the 123-year history. Again, we're using 1,000 point, and the Dow was not even 100 years ago. But you get the point that much more volatility than we've seen. Today, after hitting all-time highs in September, the market crashed more than 20% to end the year. What did it crash on? The tariff was, that was early on in the year. We were kind of on good standing with tariffs. Towards the end of the year, getting along a little bit more. But it crashed because of Fed policy concerns that they would not ease as fast in 2019. Really? Like that pushed the market down 20% because earnings weren't that bad. Consumer spending was still strong. Unemployment is still lowest in history. Crazy. And when you look at December alone during that sell-off, the S&P 500 fell 9%, making it its worst December since 1931, 9%. And in December, that included 9 separate days where the index fell more than 1%. So 9 straight days in December alone, the major index fell, the S&P 500 fell more than 1%. That only happened 8 times in all of 2017. It happened 9 times just in December. Now you say, well, it was 2018, a lot going on. 2019. What do we see? The markets quickly surged back, right? Basically recouping all of its losses from September through December, like it never happened, right? So we're getting pushed much, much lower with algos. And we've already seen 5 sessions where the Dow declined by more than 600 points this year, 600 points or more. So if you're looking at this month, you want real data, like real up-to-date data right now, because I'm talking about 2018, full year 2019. Let's talk about August, this month. The S&P 500 index swung more than 1% for 14 straight trading days this month. 14 straight trading days. That's massive volatility. And we're talking about the large cap index. So the new age of algos, volatility is only going to get more extreme. Trillions of institutional dollars expected to flow into these system-based hedge funds, and it's going to get a lot worse. Because all these guys are competing. And what are they competing for? Speed. To get in and out of trades. Now, before I get to speed and how fast these things are, let's cover volatility really quick. It's something I mention a lot, especially over the past 2 years. I just mentioned a lot in this podcast. It's simply the pace at which a stock increases or decreases over a certain period. So everybody knows that the main gauge to track that is the VIX, right, which is the fear gauge. So it calculates the option prices on the stocks in the S&P 500, and from that data, it measures what the anticipated market volatility would be over the next 30 days. Please stay with me. I'm going over little definitions here, but it's going to trust me, I got to explain this before I really drive home the point. So when you look at the VIX, it's basically the leading indicator of where stocks are likely headed. So when the VIX rises, it's just investors are basically scared to own stocks. And when it falls, it suggests investors see few risks in the market. Today, the VIX is trading at 19, around 19. I think that was as of yesterday. That's 60% higher than it was trading 1 month ago. All right. That indicates investors are becoming increasingly fearful of owning stocks. That could be true. I mean, there's evidence to that where you're seeing more money flow into utilities and negative yielding bonds. I mean, you see it, right? You see the evidence behind that. Now, to better understand the VIX, I want you to think of it as a percentage. For example, with the VIX trading at 19, and we'll say 20 to make it easier, means the S&P 500 has a very high probability of trading within a 20% trading range over the next 12 months. What does that mean? It's a telling indicator considering the S&P 500 declined by 20% plus just 2 times since the 2008 credit crisis. That was October 2011, and then the period I mentioned early, September through December 2018. But the VIX suggests is going to happen over the next 12 months. Pretty crazy. Now, when it comes to small cap stocks, which is my neck of the woods, and a lot of people don't talk about this. And Andrew mentioned how small caps have gotten killed. We've seen it. I have a small cap newsletter. You've seen a lot of these things. We're up on a lot of situations. It's definitely a more difficult market. I think it's a great time. This is a bullish on stocks to buy some of these small caps that are depressed, which I have a great small cap that was pushed down for algos and CVO that, again, you guys should have received already in that issue. But for small caps, there's a separate volatility index. I want you guys to look it up. It's RVX. And it calculates the option price of individual stocks in the Russell 2000 small cap index. The RVX is up over 65% from its July lows. I mean, July lows, 65%. We're talking just what? July. It's August. It's the end of August. It's trading around 25. So it indicates investors are scared to own small caps right now, which, could be good from a contrarian point of view. More on that later. But the RVX is suggesting the Russell 2000 index will trade in a 25% range over the next 12 months. That's a pretty big number. I mean, if you're looking at the Russell 2000, and we'll talk about trading ranges, I'm just going to talk about pullbacks here, about 25% pullbacks. The Russell 2000 only had 10 pullbacks of more than 25% in over its 40-year plus history. Yet that's what the RVX is telling us, that you're going to see a big movement in stocks. And again, it could be up or it could be trading range, but I'm just trying to put things in perspective of how the VIX is telling us something, right? It's predicting. Again, it's one indicator. It's not a factual indicator. It's kind of like, hey, this could happen. But if you're a believer in the VIX and a believer in the RVX, it's telling us that the markets are going to be more volatile than pretty much the most they've been in history over the next 12 months. You need to know that. Because I mentioned earlier, the increase in volatility, there's no coincidence, right? When 80% of all shares trading in U.S. stock exchanges are coming from algos, and the biggest funds using this system, they're going to argue that algos are good for the market. It creates more liquidity for investors. It proves accuracy. You don't have to worry about, humans making it. Machines aren't going to make the mistakes executing trades. No, it could be inputted in the computer wrong. But it's much, much better, right? That's what these funds argue, which is complete horseshit, right? The biggest players are basically using algorithms to front run the market. And if you're looking at algos, they can predict price movements based on current market orders. The faster algos can then place, guys, listen to this, millions of trades in less than a half a millionth of a second. Okay? Think about that for a minute. That's more than 1 million times faster than a human mind can make a decision. That's right now. We have 5G coming. Advances in the cloud. This is going to become faster and faster. I mean, throw in data analytics and how quick you can analyze that. Hey, there's a reason why the biggest retailers, insurance companies, car companies, they know exactly every move you make on a daily basis. It's no coincidence that you'll talk about something and 2 minutes later on your Facebook account or your Twitter account, you're going to see an ad for it. That's not a coincidence. It's crazy, but they monitor it. That's how fast it is. Now let's get back to Wall Street and the algos. The companies that are doing this, right, means better performance, which in turn leads to more client fees. We're talking 2% of assets, 20% of profits are trading firms like Bridgewater, Renaissance. I mean, those are the two biggest quant funds out there. And for Bridgewater, I think it's 3% of assets. So that means no matter what they do, they collect 3% fees. To put that in perspective, I think the S&P 500, to own the S&P 500 through Vanguard, through their ETF, the fees are 0.04%. Right? These guys are charged 3% no matter what, plus 30% of everything they generate. I mean, it's insane. It's insane. But they have the return. They're great performance. Why? Because they're basically front-running the market. You have Michael Lewis, Flash Boys. He wrote that book 2015 about machine trading firms rigging the stock market. No one really paid too much attention to it back then. It's interesting because Netflix just acquired the movie rights to that and plans to release the film over the next 12 months. I want to see how in depth, because this is such a secret society. They're signing NDAs that will put them in jail if they say anything. I mean, that's totally proprietary, these systems, these algos. We have Bridgewater hiring the best mathematicians from every single college who are probably making a few $100,000 and they pay them $3-4 million a year because, they're generating billions in fees, right? Which is crazy. So when you're looking at this and how crazy it is, it's a race for speed because speed is everything when it comes to algos. I mean, I've done research on this where experts say a connection that's just 1 millisecond faster than the competition could boost a firm's earnings by as much as $100 million per year. How crazy is that? So it's a race to be first. That's why you're seeing all these funds. Let's put this in real world. When you see a stock that beats earnings and they're up 5% pre-market, right? If they reported the day before or early that day, they're up 5% pre-market. The algos are able to get in. The best ones are able to get in first. And you're seeing, what are you seeing? A lot of times these stocks will go up 10%, 15, 20% close a day. That's more and more algos. So there's a race to become first. This way you're buying it first and you're accelerating those returns and increasing those returns. So you're looking at speed. It's why the largest trading firms are spending upwards of, I think it was $300,000 per month, I read, to place their servers as close to the exchanges as possible in order to boost transaction speeds. Now, not every expert on Wall Street believes in this system, right? Because there's a lot of people that hate Wall Street and look, they're getting over on you, whatever. I mean, Leon Koopman, found on Mega Advisors, great hedge fund manager. He was on CNBC a few months ago. I think it was actually December or January. And he actually said, I think your next guest ought to be somebody from the SEC to explain why they have sat back calmly, quietly, without saying anything and allowing these algorithmic trend following models to wreak havoc with what has, up to now, been the best capital market in the world. Torsten Slok, which is Deutsche Bank's chief international economist, listed algos as one of his biggest risks for the markets in 2019. I agree. I don't know if it's going to be 2019, but yes, that's a huge risk, unheard of risk, black swan, pretty crazy. That's what scares me. Not all the risks that you're reading about. Again, we know that. We're reading about it. We're adjusting. If you really think we're not going to be able to pay our debt, you'll see it show up in interest rates. You'll see people start buying insurance, CDOs, things like that. That's not there yet. The bond market's fine. It's not saying that we're going to have a recession. Yes, you have inverted yield curves that sometimes predict a recession or indicate a recession. But we know about these risks. And when you know about them, you could adjust because you see them coming. I don't think anybody knows how big of a risk this actually is. 80% of all trading. These guys are front running the market. They're not looking at fundamentals and good stock pickers. No, they're looking at orders in the market. Not only that, they're placing what is it called, spoofing, tons of orders in the market that are not going to get executed to make it look like something and trying to get traders and create even more volatility so they can either dump or stock. I mean, there's a lot of manipulation going on and nobody's monitoring this. Nobody, no regulation, nothing. And we had how many flash crashes? At least 2 or 3 where the markets just crashed by 1,000 points. And you're like, what? Wait a minute. And the next day, a few minutes, they're up higher. But the race for speed and all these guys and all the funds and the trillions of dollars that want to get into this because their returns are so much better than everybody else, because basically it's almost like they're cheating legally, right? There's no laws against it. It's fine. But why am I saying all this stuff, right? Because I have a lot of guys on Wall Street that have quant funds, and I get it. I understand. I'm not picking on them. But my job is to give you advice to individual investor, and you need to adapt to the new norm. Because you're looking at stocks that normally fall 10% on weak earnings and now falling 30% plus in days. Stamps.com, which he brought up. I mean, look at that move. Should it be $30? Obviously not. It's up 100% from its lows, right? I mean, you would love to buy it at 30 and get to 60 in a couple of weeks, but you really try to, you want to try to use this new system of what's going on and take advantage of it. How do you do that? Be patient. Watch the markets. And follow the technicals. And if you're not a technical analyst, just look at the 50-day, 200-day moving averages to start, because when they break, that's when you're seeing like these crazy movements. But technicals are becoming much more relevant today in the new world of algos, and you have to pay attention. You have to adapt. I would look for insider buying stocks that got crushed. That's the one that I recommended in CVO. That's down 70% in 3 months. Went from 80 to 13. And now it's like 17. It came back a little bit. But the stock, this company is going through a change. And, based on the numbers that I looked at, it should have been down 20%. We should have been trading at 60. It went down to 12, 13. So much so that 5 different directors started buying the stocks. That indicates, if you look at what Andrew said, you want to try to find a base. We'll wait to see if it's like, say, if the stock went from 80 to 20 and it went to 23, went to 20 again, keeps bouncing off that. You can say, well, you're getting a lot of demand, a lot of buying at 20. And then you see insiders buying. Now you're buying a stock that's completely artificially oversold at a completely dirt cheap price. And in months, you're able to capture great returns. That's what we're doing in our newsletters. We're adapting to the system. That's the new norm. It's not everything that we're doing, but you have to pay attention. If you're in for the long term, fine. But just know when you're looking at your statements, it's going to be crazy. We saw a 20% correction from September to December last year. And then what? The market roared higher, 15, 17, whatever it did, 17%. Now I think it's up like 13%, 14% for the year. And these are major moves for the S&P 500 in 8 months, 9 months. I mean, it's crazy. So it's going to continue. You're going to see more and more volatility, especially when we have a president that loves to tweet about the markets and the Fed and companies. You got to get used to it. If you're a long-term holder, try not to look at your statement every month. Maybe look at it every quarter, because you're going to see 10, 15% fluctuations in that, even if you own conservative stuff. Maybe not so much if you're, in bonds and things, in very, very super conservative bonds and municipals. But if you have equity exposure, man, it's going to get crazy out there. And I kind of feel bad for individual investors because it's a crazy market, but you want to adapt and you want to beat Wall Street at its game. Be patient. When these companies report earnings, you're seeing moves of 20% in either direction, especially over that week that they report. Be smart about it. Analyze the numbers. Don't just try to catch a falling knife. As we've seen with stamps.com, 70, it traded 70 for a while, for maybe like a month, and then the stock dropped again from 70 to 35. But you want to see insiders buying, which is important. They know the most about the company. They only buy for one reason. They think the stock's going to go a lot higher. And not only you don't have to hold these stocks long term, it's almost like a short-term trade where these things bounce back tremendously off their lows. And then you could sell half and have a little bit smaller size position and just, hey, let it run. If they get things right, it's going to go back to the old highs. If not, then you'll see some bumpiness, but it's a quick way to generate very, very quick profits. And I want you guys to know more about this. I'm going to be talking more about algos. You have to adjust. That's the new market. I just brought up so many different stats, a ton of research on this. If you look at the evidence, you look at the data, volatility is just off the freaking charts right now, and it's crazy. And for me, I just want you guys to be prepared because it's going to get nuts out there. It's driven by stupid news, just crazy things that accelerate, like the recession fears dropping. The Dow dropped 800 points in one day simply because we had an inverted yield curve for minutes. Crazy. Maybe dropped 200 points. I get it. And what happened? The market came back 200-300 points. That's the market. Get used to it. Especially when we have a president as well. It's just tweeting like crazy about China, about the Fed, about market moving things. That's what's driving the news right now. So bullish on the markets, but you're going to get a great opportunity. For me, I've seen great opportunities, especially in small caps right now. Amazing small caps have gotten oversold. But that's the game plan. And just be very, very patient. Maybe look for insider buying. You want to try to catch the lows on these without trying to catch a falling knife. And look at the technicals and see what levels are holding for a little while. And you can really jump in a lot of these names and get 30, 40% profits in months as they just rebound and bounce back because the algos just, they're only short-term trades. They trigger for a couple days or maybe a week or so. And then after that, you're going to see just more and more buying come into that stock. And a lot of these things are moving higher. That's the strategy I'm using. So got into a lot of numbers there, guys. Hopefully I didn't lose you. If I did, please listen to the segment again. It's not that I want you to hear my voice again, which sometimes can be annoying. I'm trying to teach you what I'm seeing, the institutional side, and how as an individual investor, you could take advantage of it. So, guys, that's it for me. Covered a lot today. Wow, pretty cool. Love covering a lot of fun. Thanks so much for Andrew for coming on the podcast. Again, if you have any questions, comments, Frank at CurzioResearch.com. That's Frank at CurzioResearch.com. That's it for me. Thanks so much for listening. Love you guys. I'll see you in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.